Hello. In this unit of security analysis and portfolio management, we are going to discuss about financial statements and their analysis. The financial statements means that is the reports that is published by different companies at the end of a particular accounting period. Why do we need this financial statement is because when the investors have invested lot of money in the company, they like to know about the performance of the company at the end of the particular period. So, to keep that in mind, having kept that in mind and also taking into consideration the different other stakeholders interest like government, suppliers, creditors, banks and all, the companies report their financial performance at certain period of points of time. So, in this particular session, we are going to discuss about what are the financial statements and what are their typical content, why should we go for financial statement analysis, why it is the purpose and what are the tools that we can use for financial statement analysis. So, as we discussed, financial statements are supposed to provide information that bridge the gap between the company and the investors in terms of what the company is doing, so that the investors come to know at certain periods of time interval. So, in this coming to the first one, that what are the financial statements that we have. Financial statements, we have one of the major statement is called the balance sheet, and balance sheet, then we have another called income statement, then we have got a cash flow statement. Balance sheet, income statement, cash flow statement, they are published regularly. If it is annual accounting year, then at the end of the particular year you will find these three reports getting published. What happens, at the end of the year, after the accounts are audited, the company comes with the financial results and also comes with something document called annual report. Annual report will have these things. At the same time, if the company is also listed in the stock exchange, as per Indian law, the companies are supposed to disclose their financial status every quarter. So, they will be disclosing about the summary balance sheet, summary income statement at the end of every quarter. So, they will disclose to stock exchange and also they will publish the same thing in the leading newspapers, financial newspapers and other newspapers. So, through that the investors can come to know about it. Then coming to the major aspect of balance sheet is essentially a statement of financial position. It says what the company has at a particular point of time. It also statement of assets and liabilities. Assets means what the business own, and with those things only business can prosper, can generate revenue. So, assets indicate what the company has and how well it can do and what revenue it can generate, what is the source of revenue, all those things can be known. That means, how efficiently asset can be utilized, the assets are relevant assets or not. So, investor can come to know from this financial statement called balance sheet these assets, and the liability is something which the business owe to non-owners, and then we have got something called equities what the business owes to the owners. In fact, whatever business owes, whether it is to owners or outsiders, it is broadly known as liability. It is liability of the business to the outsiders as such, and in this broad outsiders can include the owners, but in a very from management point of view, the owners are supposed to be the insiders of the company, and they have invested also in the company, they also expect something from the company. To that extent, business is liable to owners. So, broadly owners stake is a liability for the company, but they are insiders of the company because they own the company as such. Otherwise, whatever they owe to the banks, suppliers because they have taken certain credit, banks because they have taken a loan, or other investors like debenture holders, bond holders from whom they have borrowed money, they come under liabilities of the business. Then we have another major statement which talks about the periodic financial performance, how this company did, and that is called income statement. So, income statement essentially give a summary of revenues and expenses. So, revenue from the main line of activity, revenue from other sources also like other income, like the company might have invested something in the securities and that or other investments in some other companies. From that the company might have got some interest or dividend. So, that also comes one of the sources of revenue, and then also that is some called expenses also are there. Expenses, so revenues and expenses are the major part of income statement, and expenses will be given a broad classification like manufacturing expenses, other operating expenses, financial expenses like interest, then tax provision, and then subsequently after the tax is paid by the company, then one has the profit after tax and how the profit is distributed, all these things are given in the income statement. Then another major statement that we have called cash flow statement. It talks about that where from the in cash has come and where has the cash has gone. And this cash flow statement classify the cash flows in three ways. One is operating, another is investing, and next is financing. We will be discussing about these typical statements one by one in detail. Coming to the balance sheet, which gives the assets. The assets are actually classified on different heads, and the first asset is called the fixed assets. Then we have got investments. So, fixed, then we have got current assets, then we have got intangible assets. When you talk about fixed assets means the company own this particular asset or holds on the asset for a longer period of time. It is not necessary that assets should be fixed to the land or something like that. Rather, the company has the intention of holding this asset for a longer period of time for a particular purpose. For a one simpler example could be the plant and machine for a manufacturing company or building for a manufacturing company or any for company for that matter, that becomes a fixed asset because this plant and machine could operate for long period of time and generate goods and which can be sold over a period of time. So, that is why plant and machinery is called a fixed asset, but the same plant and machinery which is sold by a outlet as like a trading concern is not a fixed asset for this, it is like a short term asset because they are not to be held for a longer period of time. Similar, next we have in the assets categories investments. Investment means the investments made by the company in group companies or some other company or subsidiary companies, where the intention of the investment was long term. The company does not make a short term investments, rather it has made the investment for a long period of time, like a strategy control. They have another company, so they have made some investment in equity of the company, they are a stakeholder of the particular company, maybe inside the country or outside the country for that matter, or certain joint venture they have participated some ownership. In that case, that is called investments, where they are supposed to get certain income in terms of maybe dividend or interest from that company where they have invested their money. The next thing that we have is called the current assets. Current assets typically mean the assets which can be converted into liquid cash over a short period of time. Typically, it is taken as 1 year. So, whatever asset that they have, the company has, is that can be converted into converted into cash, or the company has intention to convert into cash in a short period of time. That is called the current assets. So, current assets have got different types of assets. The first type of asset is called cash and cash equivalents. So, cash whatever they are with the company or whatever with the bank, by the company, that is called the cash there, and cash equivalent is the company might have put some short term deposits with the intention that instead of keeping the money idle, rather they can earn some small amount of interest on that. So, they may have put the money in some short term investments, but the idea is to get back the money whenever we need. So, in that case they will sell the investments and get the cash. Then we have is the receivables. Receivable means where we have got the companies made some credit sales, and out of the credit sales whatever amount is not collected, they are known as receivables or debtors. So, that is also supposed to be collected back within a short period of time. So, that is why it is called a current assets. We also have one more aspects like marketable securities, which is also like cash equivalent, where the company has invested in something like treasury bill or some certificate deposit or commercial paper, and this money can come whenever the company needs. So, the temporary investments can be sold and cash can be generated to meet the regular requirement. Then next category of current assets is the inventory. Inventory means which is kept for production or for sales. So, inventory can be like raw material of the company, it can be the working process of the company, it can be the finished goods of the company, it can also be spare parts of the company, but the inventory is supposed to be converted into finished goods and sold. Of the company is a trading concern, typically their inventory will be the finished goods which they have procured from suppliers and they are going to sell them as such, like some retail outlets or some shopping malls where they hold so many types of stocks for the customers, and those things are called the inventory, and they typically do not produce them, rather they procure from different suppliers and sell them, but they are categorized as inventory and they are supposed to be sold within a very short period of time. That is why it is called a current asset. Then next that we have is loans and advances. Loans and advances, a short term loan or short term advances given to the group companies, or employees have been given some advances which they are going to pay back within a very short period of time, that is called the loan advances, and is also known as a current assets. Then we have got other current assets which is not covered under this earlier category, like some company might have paid some expense in advance, that is called prepaid expenses, that is also called a current asset, because having paid the expense earlier, we are going to get the benefit of that expense within a very short period of time, that is called prepaid expense. So, any other current asset is also part of this particular group, and essentially this current assets talks about that how liquid is the company. That means, if there is a need for meeting certain expenses, does this company have the wherewithal to meet the expenses or not, or the company will either go for liquidating some other non-current assets or fixed assets and meet the obligation, or maybe it will go for a borrowing or something like that, which is not a proper sign. It is not a good sign for the company where there is a need and you have to meet the expenses, regular expenses, that you should have the liquid assets in your hand, so that you can meet the expenses on time. Another category of asset is called intangible assets. For instance, the fixed assets, investments, current assets, they are tangible, because we can feel that, we can see that assets, whereas intangible assets something which you can feel, but you can't see that, and intangible assets can be classified as like goodwill of the company. Then the company has got some patents, or company has got some copyrights, company has made some R&D and some technology has been developed and patented, all those things come under intangible assets. As long as this, but all the assets which has got some economic benefit to accrue to the company, then this company can report as an asset. If there is no economic benefit to come from this particular holding of the asset, then it is better that company does not show that, rather it should write up this asset for a at a particular period of time. So, asset means that which can give some economic benefit in future, which can be classified into all this type that we have discussed just now. Then next we go to the balance sheet, that is called liabilities here, and the liabilities we have got again the classification, like we have got the first one is called current liabilities and provisions. Current liability is something which the company has to pay within a very short period of time, typically 1 year, like the current assets can be converted into cash within 1 year, and similarly current liability is some liability which the company has to meet within 1 year period of time. And there we have got the categories like creditors, then we have got accounts or notes payable. Creditors mean the company might have purchased certain goods from the supplier on credit, which has to paid maybe within 1 month or 2 months or something, whatever the supplier has asked. So, till the money is paid, that is a liability of the company, it is a short term liability, because it has to be taken care after certain period of a short period of time. Accounts or notes payable is something which is certain instruments which indicate that the company owes something to someone over a short period of time, which has to be honored within a short period of time. Then one has the next item is called accrued liabilities, where the company has incurred the expense, but it has not been paid in cash. So, till it is paid in cash, maybe something like this, that some employees have worked for the company, but their salary is yet to be paid. So, till the salary is paid, it is called a accrued liability or outstanding salary, outstanding expense for that matter, and it is a short term liability, also a current liability, because it has to be taken care within a very short period of time. Then another type of asset, the liability we have current liability is called the taxes payable or income tax payable. The company has made a provision to pay the tax, but it is yet to be paid by the company. Till it is paid, the provision has been created, and that is called the income tax payable. Then the next category of liability we have is the debt or loan. Debt means where the company has borrowed some money and the company is going to repay the amount over a period of time. Also, the periodically the company is supposed to pay certain interest, and the debt can be, we have a short term or long term. Short term can be 1 to 3 years period, then you can also medium term 3 to 5 years, and more than 5 years can be taken as a long term. Long term, short term depends upon the tenure, within how many years the company is going to honor the obligation in terms of repaying back the money, that indicates as a short term or in medium term or long term. The loan also can be classified into secured and unsecured. Secured means the company can place or hypothecate or mortgage certain assets the company has, and the lender has a comfort level that yes, if there is a problem in repaying the loan, by the company, then these assets can be sold and they can get the money, and whatever there is something left over, the company can be given back. So, that is called a secure. So, there should be some form of security. If there is a security given by the company in terms of mortgage, guarantee, pledge or something like that, it is called secured secured debt. Otherwise, it is known as an unsecured debt. Unsecured debt means if the company pays, well and good. If the company does not pay, then there is no mortgage or there is no pledge of some assets, some guarantee which the lender can take a recourse and get back the money. Then we have another type of liability is called the debt only, the debt which is known as debentures or bonds. Debenture or bond, instead of having a loan of let us say 1000 crore rupees, the company can go for a loan of rupees 1000 crore from a bank or a financial institution. Instead of that, there are certain people in the retail market who will also like to give a loan to this company. This 1000 crore loan amount can be divided into of rupees 1000 each. So, there is 1 crore instruments, and these instruments are called bonds or debentures. Typically, the bonds are written like this, let us say X% n year bond of rupees 1000 each. So, this X% means the interest per annum, n year is the within how many years the bond is going to be repaid, the amount is going to be given back to the investor. What happens in this, and this value of the bond on the face value itself, it is rupees 1000. So, these bonds can be issued for rupees 1000 different investors. What happens here, instead of getting 1000 crore from a particular bank or financial institution, this is now raised from as many investors who can give 1000 rupees each, and 1 crore bonds are issued, and you have 1 crore maximum 1 crore bond holders who have might have subscribed to one bond for that matter. If they have subscribed to more than one bond, then it will be more less than 1 crore number of bond holders. So, it what happens in this case, company can raise a loan from ordinary investors. So, this is called bonds. Similarly, another same bond also can be termed as something called debenture, and debenture and bond there is no financial instrument type difference. Both are loan instruments, both also have got this X% n year, maybe 10%, 7 year bond that means 10% interest, and within 7 years the bond has to be, or the debenture has to be repaid. So, they are also known as the debt of the company. And next we have is called the preference share capital. In the preference share capital, what happens, these preference shareholders have got a preference over the equity holders regarding two things. The first thing that they have preference is the preference shareholder has got the preference regarding two things. One is the dividend, and second is the principal being repayment. So, if the company has profit, company can declare dividend, and the dividend is declared means it has to first declare to preference shareholders, then it can be declared for any equity shareholder. Without declaring for the preference shareholder, dividends can be paid to equity shareholder. So, that is why they have the first preference to get dividend payment. Similarly, if there is a need that the company is likely to repay the money because of whatever reason, maybe the company is liquidating the business as such, where all the stakeholders are given money. So, first thing that has to pay to the liability holders like bonds, debentures, secured, unsecured, current liability, all those things have to be honored. Then comes the shareholders part, and when the shareholders have to given back the money, the first preference is given to the preference shareholder. That is why they are given, that is known as preference share capital. So, preference share capital has holder, they have got two preferences, they have preference two cases, one is regarding dividend payment, another regarding the principal repayment. So, that is why they are called preference share capital. Then next we have got the equity share capital, what is known as owner's capital, is a popular source of finance, and equity capital is first thing is called paid up capital. If the company, let us for example, if the company has issued 1000 crore shares of rupees 1 each face value, then 1000 into 1, that comes to 1000 crore is paid up capital, and the company has put the money into the different assets, and then the assets have generated some sales and sales have generated the profit, and subsequent the profit has accumulated, and this accumulated profit is known as something like accumulated reserve, and this profit gets transferred to different other reserves also. So, all those things are called reserves and surplus, and which include something like retained earnings. Retained earnings means the company has made a profit of 100 crore, there is profit after paying all the tax and all the obligations taken care, then that 100 crore now belongs to the shareholders, assuming that the company has no preference share capital. In that case, all the 100 crore belong to the equity shareholder, and out of this 100 crore the company may choose to transfer certain amount to some reserve like general reserve or other reserves as the company feel right, or maybe it is mandated by the statute that instead of keeping all the 100 crore as profit, they can transfer to certain reserve, and let us say they have transferred like 100 crore rupees of profit, and so profit after tax of the company is rupees 100 crore, and they have transferred let us say 10 crore rupees to certain reserves, there is 90 crore, and out of 90 crore possibly the company can declare a dividend of let us say 20 crore for the equity holders. Then the 70 crore is known as retained earnings, that is the balance of your income statement or profit and loss account, that is left over now, profit left over for the owner. So, typically what happens, this earnings retained means this profit is getting plowed back in the company, and the company generate more surplus and surplus and surplus, like that company goes on. So, this is categorized in the reserves and surplus of the company. So, equity capital essentially consists of paid up capital and reserves and surplus. If the company has issued some shares at a premium, let us say 10 rupee face value, but the shares are issued at let us say at another 10 rupees premium, that means 20 rupees has been collected from the investor per share. The 10 rupees is also known as securities premium or share premium, that is also part of the reserves and surplus. So, whatever money the investors have put, that is the share capital and reserves surplus, as well as if there is any profit earned by the company on the investors money, and after taking care of all the obligations, that also belong to the shareholders, that is called the internal equity or reserves and surplus of the company. Then we go to the next financial statement called the income statement. Income statement has the major part is income, then they have got sales. Sales is something which is from the main line of activity, the company is into selling automobiles, automobile parts. So, whatever the company has got revenue from selling automobiles and all cars and whatever that may be. So, those things are called the sales of the company. So, net of anything that has been returned by the customers, net of excise duty, all this comes as a net sales of the company. Then besides the sales, the company has got other sources of revenue, but the company is not meant for that particular activity. The company might have got some interest on deposits, interest on investment, dividend on investment, that come under the category of other income. So, that is the total income. Then the company can have the expenses, like something called operating expenses. Operating expense, those expenses which are essentially required for the operation of the business. So, if you are taking example automobile company, so those machines use machine expenses, labor expenses, the raw material expenses or the spare parts they have purchased, or marketing expenses, distribution expense, all those totally covered as operating expenses. And having done that, if the company has borrowed some money, in that is the company has to pay the interest on the loan, that is called the financial expense, and after that whatever the profit is left, then the company pays the tax, and then after taking the tax, paying the tax, there is a net profit, and this net profit is appropriated as we discussed earlier. It will be appropriated by transferring some amount to reserves and distributing some profit as dividend, whatever is left over, that is called the retained earnings of the company. Next we have is the one of the very prominent statement these days, that is called the cash flow statement. What happens in a preparation of income statement, there are certain accounting principles, accounting assumptions are actually followed. So, in that case what happens, the expense recognition of by a particular company can be different as per different rules as such. Let us take a simpler example. There is a company has something called a fixed asset, of rupees 10 crore and the asset has a life of 10 years, and at the end of the 10th year the salvage value of the asset, let us assume it to be rupees 1 crore. That means, rupees 10 crore minus rupees 1 crore has to be spread over a life of 10 years. This is called actually depreciation of asset, that is of rupees 0.9 crore. This method of depreciation, when you reduce the salvage value from the original cost and divide by the number of years of the life, that is called this straight line method of depreciation. And the company can also follow subject to the accounting rules, the company also can follow some other depreciation method, that is called written down value method. So, what happens in this case, the company, let us say the method is also, in this method also there is a 10% rate of depreciation, but so in the first year, year 1, in both the method the depreciation is in straight line method as well as in the WD method, the method depreciation 10%, then is also 1, at the end of the year the value of the asset is 9 crore as per both the methods. So, in year 2 what happens, in as per straight line method the value of the asset is now 9 crore, as per written value method the value of the asset is also 9 crore, but in straight line method since the amount depreciation is same across the time period, that whatever has been there, if the 1 rupee 1 crore is 10% original cost is taken as depreciation. So, 9, then in this case also again 9 minus 1 it becomes 8, whereas in case of written value method it will be 10% of 9, that becomes 0.9. So, it becomes now 8.1. So, there is a difference in depreciation amount, that is 1 crore versus 0.9, there is a difference in the value of the asset, that is 8 versus 8.1. So, we have taken a different example here, there is an asset of 10 crore and there is no salvage value, in this case we have assumed, and we have taken 10% depreciation method, the depreciation rate in both the method, and the first year 1 crore, 1 crore, 9 crore, 9 crore is at the end of the value. Then in the year 2 we have 9 crore versus 9 crore also in written value method, but depreciation amount is different in straight line method and WD method. So, what happens in this case, if the company has made a profit before depreciation and tax of 6 crore in second year, in that case depreciation has to be taken out, that is in this case we take out depreciation of 1 in SLM, and in WD method we take out depreciation of this much amount, that is 0.9. So, the profit before tax as per this is 5, whereas as per this is 5.1. So, because of change in depreciation method, the profit before tax has actually changed. So, in that case what happens, actually depreciation does not involve any cash flow, but there is a method that has to be followed and depreciation has to be allowed, is an allowed expense. So, by having allowed different amount of depreciation different methods, the company is able to show different amount of profit as per different methods, but a company can choose only one among them. So, this like this there will be lot of subjectivity that could be involved in preparation of income statement and balance sheet. So, in that case the actual profit can be different from one person to another person, the way they actually calculate. That is why somebody says that profit is an opinion, because like opinion can change from person to person. Similarly, profit also can change from one person to another person, the way they calculate. Whereas, to take care of this particular problem, there is a statement called cash flow statement, and cash flow statement actually talks about how much cash has come to the business during the period and how much cash has gone. See, besides telling anything else, it also talks about how liquid is the particular company, what is the liquid source of money for the company, and how is it able to honor the obligations, where has the money been put. So, all those things can be there. So, the cash flow statement takes care of certain limitations of balance sheet and income statement, and the cash flow statement what happens in that case, the cash flow is classified in three major activities. That is, first one is called the operating activities. In the operating activities, what happens, whatever the cash that has been generated by regular business operation, which does not consider any income from other sources, rather from the mainline activity like sales, whatever cash has been generated, net cash having taken care of all the expenses, that is called the cash flow statement. As it is mentioned this in this, the profit is adjusted for depreciation, gains or loss on sale of non-current assets. That means, if the company has got a profit after tax of rupees 5 crore and the company has charged depreciation of let us say 1 crore earlier, in that case, because the depreciation does not involve any cash outflow. So, this depreciation gets added, and that means the company is actually made a cash profit or cash from operation of 6 crore, and it has been actually showing 5 crore profit because the depreciation is deducted. Now, since depreciation does not involve any cash flow and the depreciation has been added back. Similarly, if you presume that this profit after tax has also considered certain other income from other activity which is not the mainline activity of the company, let us say another rupees 0.8 crore. In that case, there will be a reducing effect to final cash, because this profit after tax, which is typically should be a profit from the operation, includes a 0.8 crore of income from let us say investment. That means, if this 0.8 crore income was not there, the profit would have been something less. So, this will be having a negative effect, and possibly now it becomes now 5.2 crore. So, if there is any such income or expense which is not operating in nature, which does not involve or maybe does not involve any cash flow like depreciation, in that case those things have to be adjusted for, and the cash from operation is actually found out. Next thing that we have in the cash flow from investment activities. So, in this case the cash flow is purchase of non-current assets like fixed assets, and if the fixed that is becomes cash outflow, and if the fixed assets have been disposed of and some cash has been generated, that becomes the inflow of the company. So, that is called the investment cash inflow. That means, the company is putting money into the assets which is going to generate revenue or income over a period of time, and so that the company can sustain on its own, sustain over a period of time, because they can meet the expense. So, expansion projects, acquisition of fixed assets, acquisition of building, acquisition of land for expansion, all those things, they come under like income from cash flow applied in investment activities. If these assets have been disposed of, sold, and some cash is realized, that becomes some cash inflow for the company. The next thing that the company has, the cash flow statement has, is cash flow from financing activities. Financing activity means the how whether the company has gone for raising any loan, the company has gone for initial public offering or further public FPO or public offering or FPO or IPO for that matter. Company has raised certain loan from some financial institutions, short term, long term, medium term, whatever that may be. So, these are the financing ways of the particular company. So, that becomes the financing inflow of for the company. At the same, the company has paid like interest, company has paid the dividend back to the shareholders, company might have repaid the loan, company might have paid back the debentures, redeemed the debenture, redeemed the bonds, and for that matter whatever they has been given back to the investors because they have financed earlier, that is called the financing outflow. So, net of these cash from operating activities, net of inflow and outflow, then net of investment activities, net of inflow and outflow, similar net of financing inflow, net of finance outflow, these three figures will be there. If the company has got a net operating cash flow as rupees 7 crore, that means 7 crore has been net of that is inflow is more than outflow, then financing is let us say there is a 2 crore within bracket, means that is a net outflow, whereas investment there is another 3 crore of also outflow. The net cash flow during the particular period, combination of this is 2 crore, and this is the 2 crore cash that has come to the business on net, having, that means the 2 should be the net of all cash receipts and all cash payments during a particular accounting period. That means, if the cash balance in the beginning of the period was rupees 7 crore, for assuming that, then the cash balance, ending cash balance should be rupees 7 crore plus this rupees 2 crore, that should be rupees 9 crore. So, net of the cash flow statement will be reflected in the net of the different cash flow, that is operating, financial or investment cash flow. We can go to look at different sources of financial information, where do the investors get this thing, because all these informations are required for the investor decision, make a decision whether the company's share should be bought or not, should you hold on the investment or not, should you sell this or not, because these in sources of information, these financial statements give very vital information to the investor about the performance of the company. So, that the investor can decide about whether to hold on to investment or not. So, this information can be found out, as we discussed, at the end of the every year the company publishes something like annual report. The information also can be there from the different secondary database by subscribing to that, or there are certain information services for a particular subscription, for a particular payment they can also give. There are also stock exchange that also, because there the company is supposed to disclose the information, and stock is also publish those information on their website or some other document. At the same time, there is a very good print media where the company's reports are published. Certain periodicals are also there, exclusive reports are also there published by different research agencies. Then the company's own website or website of different analyst companies, from where these information can be found out. What we can do now? We can now look at certain example of annual report. There is an annual report of the company called Infosys Technologies, and the annual report is for 2008-9. The annual report has got the content of whatever the company has been doing. It has talks about the company's performance, it talks about company activities, who are the main players, who are the major employees. It talks about everything in this case. At the same time, the company also publishes something like what the company talks about, what the management thinks about, that is called management discussion analysis, called MDA. They talk about how they feel about what the financial performance, operating performance of the company. This company also had something like risk management report getting published as a part of annual report, what are the risk of this company, where they are exposed to. Then it also publishes those information that we are discussing, that is called the balance sheet and income statement. So, one can look at it. These are the different sources of funds, that is called liabilities. In that we have got the shareholders funds, then a shareholder fund we have got share capital, as we discussed, we have got reserves and surplus. So, this what happens in this, they give for 2 years, this is for the year ending 31st March 2009, and this is for the year ending 31st March 2008. That means, one can compare easily what is the difference, what was there in previous and what is now in this year, and each major item has been supplemented by something called a schedule, which is given at the end of the particular statement, and at the end in the as a part of this particular report. So, in this if you can, one can see here the share capital of this company was 286 earlier, it is also 286 crore this year. Then it has the reserve surplus of the company has gone up from 13,204 crore to 17,523 crore. Like that, this is the liabilities, and then the company has got the application fund, that is called the assets of the company. It has got fixed assets, it has got then investments, then it has got certain assets called deferred tax assets, net, then it has got the current assets, loans and advances, where debtors, cash and bank balance, loans and advances, and these current liabilities, instead of showing as a part of liability of the company, these have been shown as a deduction from the current assets. So, that is, and this current assets minus current liability is called net current assets, and then the companies has got the total assets of 17,809, which was actually earlier 13,490 crore, in the previous year. And then similarly, the company has also got the income statement, that is called profit and loss account. In this, the income major activity like income from softwares, because the company is software development, software expenses, income from software products. Then it has got software development expenses, the major expense. It has got, then the next line is called the gross profit. Then it has got the next expense called selling and marketing expense. Then they have got general administration expense, and after that they have got operating profit before depreciation. Then depreciation taken out, they have got operating profit before tax. Then they have done, they have added the other income, and then they have got net profit before tax, and then they have made a tax provision of whatever amount. And in this also they have got a provision of 894.5 crore, which was 630 crore previous year. In this statement also, alongside you have got the previous year's state values, so that the investor can compare what has happened before and how it, what is now as a part of the income statement. Then balance, we have net profit after tax, and whatever the balance was there in the previous, it has come, and then the amount has been distributed like dividend. Company has paid dividend, interim dividend, final dividend or special dividend, total dividend, and some amount has been transferred to general reserve. Now, whatever is left over, that is 12,460 crore is the reserves and surplus of the particular company. This can be checked here also in the balance sheet, that as a part of reserve surplus, this 12,460 is the part of reserve surplus, that is 17,523 crore, and the detail of the reserve surplus is given in a schedule called schedule 2 at the end of the financial statements. And then next thing that we have is the cash flow statement of the particular company. As we discussed, it has got first the cash flow from operating activities, then cash flow from investing activities, and cash flow from the financing activities, and net of all these three different cash flow has been this amount, that is 73. That means, the cash net of the cash flow has been increased by 73 crore during the particular year, which was 18 crore in the previous year. So, this is the way the companies publish their financial statements in as a part of their annual report. Next, we move on to the unit that is called the analysis of financial statements. So, having got this information from different sources or this annual report, from this cash flow statement or from this balance sheet, from income statement, one can make an analysis of the financial statement, that with the different tools and techniques, how this particular company is actually doing. So, what happens, why should we go for the financial analysis, is that it helps us evaluate the past performance and the past financial position. So, how this company has been doing in the previous period, and what has been the particular company's position, what is the strength, what are the weakness of this particular company, and those things can be found out with the help of financial statement analysis. Then it also helps us predicting the future performance, and it also helps in something estimating risk. So, we have already discussed in risk and return what is the risk involved in these particular companies, and possibly this information source, these financial statements analysis can give an indication how risky is the business with certain tools that are being applied. And also financial statement analysis can help us finding out what is the cost of capital of a particular company. When we say cost of capital, we mean the return expected by the investors. It could be equity investors, it could be debt investors. This financial analysis also can help, because we will always expect the company to outperform the expectation of the investors. If the investors overall expect, let us say 12 or 14% return, the company, let us say 14% return, in that case company should earn a return more than 14%, then it says okay, it has made the investors requirement in terms of what they have required as per return is concerned. So, then capitalization rate, that is also same thing like cost of capital, and it also, this financial statement analysis also helps in estimating the appropriate valuation multiples. We will discuss that in a subsequent session when we talk about valuation of shares. In that case, what you, there are different methods. One of the method is called price multiple. possibly one will be aware of a multiple like price to earnings ratio are called PE multiple. So, the PE multiple is actually found out by dividing the price of a particular share with something like earnings per share. So, the price of a particular company is rupees 150 and the earnings per share, which is known as profit after tax divided by number of shares, that let us say it is 30 crore is a profit and 10 crore number of shares are there, then rupees 3 is the earnings per share. So, price earning multiple is now 150 by 3, that is 50. So, that means multiple, the price is 50 times of the earnings per share. Like this is called a relative valuation method technique also, because one can find out the PE multiple of different companies like this. So, this is 50, there can be 20, 30 like this, and may take an average of that, and this average P multiple can be taken as a base of saying the P multiple of this target company that you one is evaluating is high or low. If the average P multiple of this let us say comes to 35, and if you have a P multiple of this company is 50, obviously this company share is overvalued. So, this is called relative valuation relative to other companies P multiple. What is this P multiple here, and accordingly is overvalued or undervalued. So, these valuation multiples can be found out with the source of information that is there in the financial statement, and with the help of financial statement analysis tools and techniques one can estimate the value of the particular company by using this valuation multiple. So, P multiple is one of the value multiple. There can be different valuation multiples which will be one can discuss in subsequent valuation of the shares session. Then coming to the next thing, that is what are the different tools. We have got the first thing that is called a trend analysis. So, in the trend analysis what happens, the company's major financial figures are compared over a time period, and then one can observe a particular trend in the same. So, what happens in that case, let us say for 5 years the company's sales are observed and how these sales have actually moved over a particular period of time. So, sales might have gone up from 100 crore, 120, 30 like that up to 5 years some figure it must have reached, and what is the trend, whether the sales is declining, sales is fluctuating or sales is continuously increasing like that. Similarly, this trend can be observed from any major financial figure of the particular company. It can be observed from major expenses, the raw material consumption, labor expenses, electricity expenses, other operating expenses. Then similarly, financial expense like interest, how this interest expense is going up or coming down, what has been happening. Then at the end in the income statement, the company's profit after tax, how it has gone up or come down. The sales have gone up by certain percentage over a period of time, or the profit after tax also gone up by that percentage or more than that or less than that, or the profit is after tax of the company, net profit of the company is declining or increasing. All those things can be observed with the help of a trend analysis. Essentially, one can take a period of 5 years and see how this particular major financial figure are changing. So, besides income statement, the trend analysis also can be applied for the balance sheet, how the total assets have been decreasing or increasing, or increasing for some period then it decline, or other way around. Similarly, the total assets is increasing, decreasing, then for the fixed assets the company is increasing or decreasing, then current assets, how is the trend in that. So, all those things can be observed by comparing these figures over a period of time, that it comes under trend analysis. Then another thing that the company the analyst can do or a user of the financial statement can do is make a comparative statement also. In this case what happens, one compares the financial performance of the company for 1 year with another, that we have already seen in the example of Infosys. We have got the financial statement here, and so we see the income statement. What has happened in this case, the income from software, service and products of Infosys for 2009 is 20,264 crore, which is actually 15,648 crore in the previous year. There are around 30% increase is there as far as this year's income is concerned compared to the previous year. So, this is called the comparison of particular company's financial performance over a 2-year period of time. At the same time, the comparison can be done with any other company. Let us say Infosys performance can be compared with the TCS, or it can be compared with the company like Wipro, any other company which in the same software sector, that can be compared, and one can find out which company has done better, which company has not done better compared to the others. So, this is a comparative financial statement, because essentially the investor is going to compare different instruments of different companies, let us say equity share of different companies, and in that case they can take the financial information of different companies and compare which company has been doing better than the other company, and make a decision whether to buy or sell the share of the particular company or not. So, that is the called comparative financial statement. Next we have is the common size statement. What happens in this case? The financial statement is presented by representing each item as a percentage of a major figure in that particular financial statement, like income statement or the balance sheet. In income statement, how it happens, each of the item is compared with this net sales, taking net sales as 100, how other items have actually gone up, or is more or less, it is 100 is in 5 or 10 or 8, something like that. So, the common size statement essentially gives a breakup of the different items compared to the main item of the common statement income statement called sales. Similarly, common size balance sheet also can be prepared, where the total assets of the particular company, total liability of the particular company is taken as 100, and compared to that how the other assets or liabilities are there, that is explained. And so, that what happens in this case, over a period of time one can find out if the, for example, if in a particular year, let us say we have got a balance sheet of a particular company, where we look at the asset side, and asset side 2009 March and 2008 March, the assets total was, let us say 200 crore. It was 200 crore in 2009, it was actually 180 in the previous year. And what happens in this case, this 200 or 180 respectively is taken as 100. Then if this 200 crore is comprises of fixed assets of 120 and the fixed assets of then we have current assets like investments of, let us say 20, and other assets, current assets called 60. So, total becomes now 200, which was there in the total, and similarly this 180, it was actually 100 as far as fixed assets is concerned. Then as far as investment is concerned, it was 20, and similarly current assets was actually 60. So, total is now 180. So, if one looks at the 20 of investment remain 20, current assets also remain 60 as 60, whereas fixed assets have gone up from 100 to 120. So, this is a comparative analysis. Then this 120 as a percentage 200, taking the total as 100 can be converted. So, this becomes like 60%, then this becomes 10% and this becomes 30%. So, likewise one can also find out 100 by 180, 20 by 180 and 60 by 180. So, like that one can find out the percentage and compare the percentage with this one. So, one can find out that yes, whether they had more fixed assets as a percent total assets or less, how this the fixed assets X percent has become to 60%, whether it is increasing or decreasing, the composition asset is changing or not. So, that can be shown with the help of a common size statement. So, both common size income statement as well as common size balance sheet can be prepared, and one can see that. When we can have a look at an example of one company, that is called Natco Pharma, and here we have got the income statement of the company, there is a sales turnover, there is excise duty, the net sales, and other income, then we have a stock adjustments. Total income is come at 288.29 for the year 2008-09. Similarly, we have got expense raw material, power and fuel, employee cost, manufacturing expenses, selling expenses, operating profit, depreciation, like that. And what has happened in this case, we have made a comparison here, that is in the net sales of this particular company for 2008-09, which is 269.69 crore, it has been taken as 100. Then accordingly, rest of the items the income statement has been covered, and we can see here 100, 100 and 100 for 3 different years the final statement has been given. And in that case, the raw material, take an example, is raw material which was 42.93 as related to sales, it has now become 40.14 in 2007-8, it has now become 35.82 in 2008 and 9. That means, as a percentage of sales, raw material has actually declined. So, which is actually a good sign for any company, because the cost has as a percentage total sales has this particular raw material cost has actually declined. So, similarly, power and fuel cost, which was 5.48 in 2006-07, it is declined to 4.81, it has now become 5.65. So, like that, employee cost, which was 13.56 has remained almost same, 13.23 as a percent of sales. So, like that, all those expenses, everything has been categorized as a percentage of sales, where sales is taken as 100 and rest of the items have been taken. Similarly, it can also be done for common size balance sheet, where the total of the balance sheet, total liability or total assets have been taken as 100, like 2006-07 339.65 is taken as 100, and similarly for 2008-09 total assets is taken as 494.69 is taken as 100, and accordingly how these other assets have actually moved or declined or whatever that may be. That means, if you look at here, the share capital, which is 8.14% total liabilities, it has declined to 5.67%. Similarly, the total shareholder fund, which is 53, has become now 50. There is a marginal decrease in the shareholders fund. So, coming to the asset side, which has earlier they used to have 40 point, on an average the company has maintained some 40 to 43% of total assets as net fixed assets, whereas inventories, which was 14.52%, has now become 13.07%. So, like that, all the assets have been now classified, and the composition has been given. So, this composition, how it has been there in the earlier year, how it is in this year, it talks about whether this company has put more money into fixed assets, more money into investments, or more assets are in terms of current assets, in current assets more in terms of inventory, receivables, or like that. This can be classified, and so how this company is actually investing in assets, and how this company also get the different money from different sources of liabilities, whether insider source like owner source of money is more, or the outsider source like liability is more, like that it can be analyzed. So, up to this we have discussed financial statement, different types of financial statement, what are the major sources of financial statements information like annual reports, secondary databases. We have also started discussing about different tools of financial statement analysis, where we talked about the comparative financial performance, we also talked about the trend analysis, and then we talked about the common size financial statement. In the subsequent session, we will discuss about the financial statement analysis with the help of ratio analysis, where we will find out different financial statement ratios with the help of information from financial statement like balance sheet and income statement, and judge whether this company is doing well as per different financial parameters or not. Thank you.